Welcome to the Risk Reversal Podcast. I am Dan Nathan. I am joined by my good friend Deirdre Bosa, who is back. It's been 3 months, D?
AKA an eternity in the world of tech and AI. Yes, 3 months.
Well, we're going to go over what you missed. So you guys all know Deirdre.
I didn't miss anything, did I?
No, nothing.
Nothing happened.
You know, the NASDAQ's up 14% since you left. The S&P's up 10%. There's been trillions and trillions of dollars of market cap gained by a handful of stocks.
Yep.
You guys all know Dee. She is the host of CNBC's Tech Check. She was spending a lot of time with us, graciously giving us your time before you went on maternity leave. So it's great to have you back. And I miss your reports. So you're going to be doing, let's just kind of, reorient our listeners with, obviously you do Tech Check throughout the day on CNBC. You will also be doing what?
My deep dives, which is something that we started about maybe 2 years ago now, but these sort of long form YouTube videos that we thought were pretty wonky, but has a really cool, wide audience. So if you're interested in where AI is going, that's what we focus on. We focus on things like China's role, a term called distillation, which is actually really important to know if you think about the race between the US and China. We unpack what OpenAI is doing, all the big players. And, I'm excited to be back and be with you, Dan, because I love this podcast.
We missed you. So
I hope to be a regular on here.
Listen, the mic is always here for you, D. So we got a lot of fun stuff to talk about today. I think you and I were just kind of going back and forth. I think you coined the term. We were talking about all this activity by a lot of these AI CEOs. Was it a hissy fit that you said? I think so. There's a lot of hissy fits going on. So these gazillionaires, the captains of industry as it relates to AI are acting like children a little bit. We'll go through some of that. We'll also talk about some of these deals that we've seen over the last few days, that Apple is about to ink one with Google to power Gemini, to power Siri, and relaunched Apple Intelligence. Snap did a really interesting deal with Perplexity. OpenAI CFO Sarah Friar, I think she put her foot in her mouth, but she kind of took it out really quickly, talking about what the government, how they should be thinking about the build out of these systems, and a couple other things, just generally the bubble, in calling a bubble on AI. How's that?
Right.
We'll talk a little bit about that.
I feel like that's sort of the biggest change. 3 months ago, when I left for maternity leave, it felt like these AI companies could do no wrong. And the more capex, the better, just spending. Everyone was okay with it. But over the last 3 months, and obviously I'm still very online, even as I can't get away, even with the newborn. It feels like the shine has come off a little bit. There's always been bubble talk, but it's entered the mainstream, it feels like, in the last few months. And I'm excited to talk about the hissy fits.
And there's this push and pull, I think, between Silicon Valley and Wall Street. And so we'll get into that. And that's where you live, by the way. So, so stick around. Guy and I had a great conversation with Shannon Murphy. She is the head of research at iConnections, our great partner. We talked a lot about some of the capital flows that we're seeing from allocators, where they're going to, what sort of funds, geographically. Great conversation, a lot of data. Shannon's fantastic. She's going to be back with us frequently. So stick around for that. Okay, D, let's start with this. Okay, so you and I are recording. It is Thursday morning. By the time you're listening to this, people, it's probably going to be Monday morning. But Wednesday afternoon, Nvidia, which was trading very near all-time highs, sold off about 4% into the close. And there was a headline out of the FT that obviously hit 15 minutes after the stock sold off, so somebody got a little look at what was coming out. It's Nvidia's Jensen Huang says China will win AI race. CEO criticizes Western cynicism while Beijing loosens regulation and cuts energy costs. So they're basically talking about all the new regulations that the states here in the U.S. are putting on. Listen, there's a lot of good reasons for that. Like if you think about environmental and the cost of electricity and what that's doing to people, they're doing these in rural areas that, a lot of the folks, you think about the per capita income and what higher energy costs mean for them at a time where the consumer's kind of weak, inflation's kind of high, that sort of stuff. Let's talk about, where is Jensen coming from? We know that in this recent China trade truce, Nvidia didn't get what they wanted. They didn't get these export controls lifted, but there's this other side of it, D, where, the Chinese government seems to be like saying to Huawei and some of these other folks, don't buy their chips. We're going to make do with less. Talk to me a little bit how you're thinking about that. And is Jensen going to be left holding the bag here a little bit?
So I'm so glad we're starting here, because this continues to be the topic that fascinates me the most, this dynamic between America and Chinese AI. And I think Jensen Huang said the quiet part out loud here. I know he walked it back, but the takeaway from the article and everything that he has also said, by the way, not just this FT article, but everything he said over the last few years has been so overwhelmingly positive about China's AI and threatening, but he's being realistic. You know who else said the quiet part out loud? I think this was a few weeks ago, but I thought was a really big moment, was Brian Chesky.
Yeah.
I can't remember which publication he was talking to, but he said, we're building on Qwen, which is Alibaba's AI model. And he said, ChatGPT isn't really there for us yet. We're not using it. And there's this huge dynamic that I don't think people are paying enough attention to, in that the Chinese AI models are open source and they are good enough and they are way, way cheaper. So who is the world going to build on? Like, let's forget maybe America, but maybe the rest of the world. They're already building on Alibaba's Qwen, on DeepSeek, on these models that are way more efficient. And when everyone's talking about the bubble here, circular financing, slop, et cetera, it's really the Chinese threat that I think Jensen rightly highlighted in that FT article once again.
Yeah, but is the answer to give them our best technology? So if Jensen's saying that they're already winning or they will win and that our models are not that far ahead of their models, and the reasons that you just laid out, the open source, the cheapness or something like that, is really going to be this sort of digital Belt and Road, right? If you think about it, they're going to be able to push this out there, because if you have to access, a data center with the latest, Nvidia GPU, and you get locked into the CUDA software, you're kind of locked in for good, right? And so that's one of the issues when you think about the developing world.
Right.
AI is not there yet.
Well, but would that be such a bad thing for Chinese to build on the CUDA software? At least it's coming from the US. The alternative is, you mentioned it, is the Chinese are developing on their own, not just their own software, not just their own AI models, but the hardware too, right? Huawei chips, they're still nowhere near, what American.
Yeah, they're putting together these big clusters.
Exactly.
Yeah, and they use a lot more energy that way.
They will get there, though, and the Chinese government is all in. Whereas, and this is what Huang was referring to, too, is, we're back and forth. There's a lot of debate here in the U.S., as there should be, about how much we should give them. But all the meanwhile, China is singularly focused on.
And Jensen's view is like, listen, we might as well, as you just said, have them locked into our technology. But really, when you think about what this technology is going to be used for by the state, it's for things that make them very adversarial to us. And I think that's where, in the last couple of weeks since this Xi meeting, where folks like Marco Rubio and some of these others who used to be huge China hawks, you know what I mean? And they kind of won out here. Jensen was spending a lot of time with the president. Remember when he went over to Saudi Arabia, and he's been in Asia with him, and he did this GTC thing, 2 weeks ago in Washington. He literally was saying, "Make America great again." And the president, I think he said President Trump like 15 times. They know how to make it into his heart, but like what now? It's just interesting that some of the administration is kind of, pushing back a little bit.
And, it's a tough place to be, because not only is it for AI models, but it's for weapons and defense. And you have to be careful how much you give the Chinese. But there was a specialized chip, right? And by holding that back, maybe you don't give them Blackwell, but if you hold back sort of everything, the Chinese are extremely, extremely resourceful. And I feel like I've said this a gazillion times this year, but necessity is the mother of invention, right? And look at how far they've come because of that. They are, what did Jensen Huang say? He walked it back by saying they're nanoseconds behind us instead of they will win. So
he has about 50 billion reasons a year why he wants, you know what I mean, when you think about why he wants China to have his best stuff. And this also comes at a time, and I'm just curious what you think about this, is like, when you left, for 3 years, there's been talk of competition, right, as it relates to Nvidia. And we know that they've been selling, 80-90% of high-end GPUs that all these, servers that go into the data centers that they've been using, definitely here in the U.S. And now, AMD has had this massive run. They got this huge order from OpenAI, which actually is being funded by Nvidia, because Nvidia invested $100 billion in OpenAI, and then they're giving money to AMD, Nvidia's biggest competitor, which all seems crazy to me. But when you think about it, you have custom silicon. Broadcom has done a lot of deals. Even Marvell just joined the party. And there's a handful of
TPUs
others
from Google.
TPUs. Yeah, and so you remember when, I don't know if you saw this, that Qualcomm 2 weeks ago announced that they're going to launch some, accelerator GPU and the stock went up 20% in a straight line. 2 days later, it's all the way back. So it does seem like competition is a narrative right now.
and not actually there, which has
Probably.
really been the case for such a long time. I guess when you move, though, from training to inference, right, then you have a lot more options available to you. And I think no one would deny that Nvidia, you want that to train your AI models. And so if you're OpenAI, if you're Google, you're going to want those Nvidia GPUs. But when you get to the inference, and you've seen this with, I would say, especially with Google TPUs, right, you can do it a lot more efficiently and cheaper, right? And that's what everyone's going to be looking to. But I'm with you. It's taken longer. We've been talking about this competition forever, and it feels like Nvidia still has the hold. So I don't know. I think it's just a matter of when, though. It's going to happen.
And I think it's interesting the way that OpenAI has been kind of spreading around their need for compute. Obviously, Stargate, Oracle. I mean, there's lots of things going on there. I think the financials of this stuff is going to become, this is going to be Wall Street's obsession about the depreciation rates, right? And if there ever is, some sort of oversupply of compute, what sort of pricing pressure. My good friend Jim Chanos has been, posting about this recently, that the rental prices for GPUs are just coming down. Now you could say, well, that's Moore's Law and all this sort of stuff, but ultimately, if there's going to be a lot of pricing pressure on this, these companies that are spending these hundreds of billions of dollars, it might look like, a misallocation of resources, if the demand's not there, if businesses are not able to build those things to get the return on that investment.
Well, it's been interesting to look at sort of the big players here and even how they've been trading. Let's take like a Meta versus a Google. Yeah. And I think from the last earnings report, you see that Google is using AI in like everyday products, right? They're actually putting the AI to work and its stock has been rewarded. Then you've got Meta on the other side where they see AI as like a moonshot, right? Zuckerberg's talking about super intelligence and it's like this existential quest. Who can get to super intelligence first? And I'm still confused as to why.
Or what superintelligence is, by the way.
We don't have like a real definition that anyone can agree on for superintelligence. Right. And then it's like, okay, you have it. Then what? What if everyone's already on the Quen or DeepSeek or Gemini models and you just want real practical AI that's good enough? So it's interesting to see how the market's like rewarding a Google versus a Meta. And it feels like something like, again, the shine is coming off all of this spending.
Well, there's two other things, right? So you just made the point, Meta is using it to serve better ads, right? Yeah. And they're spending hundreds of billions of dollars to do that, but there's much fewer levers for them to pull. Like they have one business, right? And if you think about it, and
they don't even have a cloud business.
That's the thing, right? So if you think about Google, you think about Microsoft, and you think about Amazon, and Amazon obviously, and you and I don't know if we'll have time today, but we got to talk Amazon. I know that's a name that you focus on a great deal. That was also one of the ones that was rewarded, but largely because of their cloud business, right. When on that last print. But when I think about just how these companies are spending, Microsoft, also has not been trading particularly well over the last few months or so, and I think a lot of it is like they got that benefit to Azure. They don't own the technology really. They're looking to diversify away. So I just think it's getting a bit more, I guess investors are getting a bit more discerning. Does that make sense to you? Mm-hmm. Yeah. Here's the other thing, and I'm curious your take on this. The whole idea, and I read this somewhere, so I didn't make this up, but the whole idea that all of our major hyperscalers, and throw Meta in there, they're all going after the exact same thing. So it's an arms race to get to AGI or superintelligence or whatever they are. Maybe they're the same thing. But once you get there, once you get the rabbit, then what?
What do you do with it?
Isn't it massively commoditized, that technology? And then to your point, if you have all these cheaper models that are open source, then you're asking yourself, what did we just spend $3 trillion on?
And so we did one of our long forms. I encourage, if you're interested,
we'll put it in the show notes.
Your viewers to check it out. But we did a long form video on this concept called distillation, which is how DeepSeek basically arrived. And this is how the Chinese models are building. You take our best models, right, that we spent that OpenAI, Google, et cetera, spent billions and billions of dollars to create, and you take the information, you basically just run it like on a hamster wheel, and you can create a model that is not 100% as good as these models, but it's good enough. And like my question is, who needs the top coding, the top math model? Enterprises, they want a great, cheap model. And you can get that without spending hundreds of billions of dollars, as the Chinese have proved. So I agree. I can't really understand how that all fits together if you're spending. I understand sort of more the Google side of it, because they have sort of that total vertical integration. They have the models, they have the infrastructure, they have the cloud, they have the TPUs, the hardware.
And they also have like 7 platforms that have over 2 billion users. So the idea of like infusing every one of those platforms, like you're not even seeing it in YouTube yet. You know what I mean? Like you're not, like, right? And so you're seeing it a little bit in Gmail. There's the productivity suite. I mean, the list goes on and on.
It also like is not good. This is another thing that we need to talk about.
Yeah, no. More and more people are becoming. I was out the other night with a tech CEO, and we had this exact conversation. There's a guy who's been around the block for a while, and he's the CEO of like I think a really well-known tech company, and we're just going through all one after one. Like trust is so huge here. If you can't trust these models as a consumer, but like if you look at Anthropic, for instance, they're not making any money from subscription from consumers. It's all the API. Yeah. So like for instance, so you could say to yourself, if you are spending, licensing it through an API, these models, and you're able to build something on it, and the trust is going to come on the application layer that the companies build. Is that fair? And the consumer thing is like, whatever. Like we've been for 30 years, we've been searching for free on the internet. No one's going to pay for it ultimately.
Right. And the other thing is that you don't necessarily, a lot of companies don't need these big giant models. They want something like you could take a Qwen, which is open source, put it on your own server and tailor it to how you need it for your organization, right? You don't necessarily need a chat GPT, which may be more expensive. You can, I think the trend is going towards these smaller, tailored,
Who's doing
more
it
customized
here? Who's doing
models.
smaller models? I know Apple was developing smaller models, and it doesn't look like it was making any sort of progress, at least the way they were integrating it into what they do. Even if you don't have Apple Intelligence turned on, they're going to say that there's some stuff going on in the operating system.
Like on the edge.
Yeah, is anybody doing anything interesting?
ChatGPT before, or maybe it was just as I went on leave, had an open source model, but
Llama's open source, right?
In Llama's, but I don't know what's going on with Llama anymore. And I was at a dinner with a bunch of AI leaders, and I asked them what's going on. Like, why aren't people using this? Because I'd heard at first that the GPT open source model was quite good, and they just all like kind of shook their head and said it's crap.
Well, to put a bow on this conversation about China, I suspect, and it's interesting if you think about how much higher the market is since that day, January 23rd, 24th, I think it was a Monday, right? And we saw literally, and I'm just going to go, Nvidia had closed that prior Friday at $143. Right now it's $197, and it closed down 17% the next day. And it proceeded over the next few months into, the lows in April. I mean, the stock sold off from its highs 44%. I mean, think about that over like a 2.5 month period or whatever. And now we're obviously so much higher. The company's gained $2 trillion or more in market cap since there. I wonder, yes, we have this truce, this trade truce. I think we realized that we don't have the leverage in most of the leverage, or the leverage that we thought we had. We need their rare earths, and we need them to buy our soybeans. What the Chinese have proven that they don't need to buy our high-end GPUs. And I wonder if there is another DeepSeek moment coming out just to kind of flex in a way where, they are now giving incentives to all these companies. They're actually encouraging them not to buy our chips. They're giving them free power or discounted power. Is there going to be a tape bomb where everyone's like, holy shit, and we see the sort of activity we saw in January?
Dan, the AI bulls are going to be so upset with you.
Yeah, I know.
So upset with you for saying that. I still get a lot of flack from that DeepSeek moment and saying, look, you had it all wrong. They've all recovered. But yeah, I'm kind of with you here. I think that there could be something else, or I don't know. There hasn't been since, and we've had these really excellent models out of China that even the top CEOs, Jensen Huang, is willing to admit. I don't know. Maybe we just keep spending forever.
Yeah, I mean, at some point though, I think there's gonna be a thing that happens. I think that they're going to do this in a way that it's outside the scope of what this trade truce is. They're going to say, listen, these are companies just developing models, and you could say a little bit of a state capitalism sort of situation. Obviously over there, that's the way their economy works. Let's talk a little bit about some of these hissy fits. So in the last week or so, obviously Space Karen, Elon Musk is always whining about something and tweeting about somebody and bullying.
Did you just call him Space Karen?
Yeah. Yeah. We'll see how that lands. Yeah. So we had Sam Altman, who was on Brad Gerstner's podcast a week and a half ago, oddly with Satya Nadella, okay, which obviously he saved him from being ousted a couple years ago. And, we know that they've had a rocky relationship. Give me your 411 when Brad is literally, and you and I know Brad, and I think he's a very, I think he's right down the middle sort of guy.
Yeah.
He calls it the way he sees it. And obviously he's a huge tech investor. I think they made it clear that he's an investor in OpenAI. And Sam Altman, literally, as much, I don't know him, I'm sure you met him, he seems like a very nice gentleman. He just was so offended by the question that they're losing tons of money and, they're spending, they have $1.4 trillion in commitments. And his response to that, rather than actually walking through, it's just math. You know what I mean?
Right.
It's math. He just said,
he didn't say anything controversial. He just read numbers. Yeah.
And this is the conversation that's going on out there. He said, you know what, Brad, if you want to sell your shares, I'm sure I can find people. Like, that was like
what
so odd, right? Like,
and then he dropped off. It was very strange.
And I think Satya Nadella was probably sitting there and he's like, you know what, dude, it's a long race, man. You know what I mean? Like,
well, Satya Nadella was my favorite part of that video because it was funny. As soon as he asked, though, you could see Satya Nadella kind of sit back and just be like with his.
He loved it, yeah.
And be like,
100%.
Let's hear the answer to this. So I kind of loved having Satya Nadella there, and
it's just weird. So give me a sense of like where we are in this moment again, because like they are, the 800-pound gorilla in the room, OpenAI, and it seems like, and you've seen those charts with like them in the middle and everyone else in there, and the circular funding and all that sort of stuff. And I almost feel like he needs all of these narratives to continue to work. As soon as some start falling by the wayside, then folks start questioning, the layers and layers of just, this cross investment. And, I've said this a few times, D, if OpenAI doesn't work out, if he is the Sam Bankman-Fried of AI, our economy is going to have a really difficult time if you think about the contribution to capex
and
that's going
those
on
charts
right
that have been circulating over the last few weeks of the circular financing and how it's really propping up this massive ecosystem, or bubble, as some will call it. Okay, I'm going to take the other side here, though. I don't think he may not be the most honest person in the world. There may be some stuff going on. ChatGPT may not have the best models in the entire world forever. I don't think it matters. And one of the smartest person I talked to in AI puts it like this, says, OpenAI doesn't really matter. For 99% of users, it doesn't matter what model they're feeding you. They won't even notice. It's now become the new Facebook. Yeah. Just that pure user base. What is it now? 800 million?
Yeah, it'll be a billion.
It'll be a billion. It'll be two, know. It doesn't really matter because they have that kind of scale, and then they can figure out how to monetize it just like Facebook did. Yeah. So it's there now as this new sort of like social network, but it's the AI chatbot of the consumer.
Have you noticed it's gotten really slow? I find I don't know why this has happened over the last couple months or so. I went back to Perplexity, and I obviously, there's a ton of different models there that you can use. I like the interface better. Yeah, no, I mean, my only point is, Sam, we're all counting on you, because if it didn't, I have this view, we'll do it for another podcast. I just think that if you take what happened in the late 90s into 2000, and it really was a similar euphoric sentiment around a new technology that we know this is going to be, yes, it's the most transformative technology of the next 50 years. Okay, we get it. But I'm looking at it through the lens of markets, private and public. And to me, this dwarfs what happened then. And then if you look at the financialization.
This dwarfs what happens in the .com?
Oh, my God. This is
but there's real revenue, and
no, I understand, but there's no profits. You know what I mean? So you could say, the cloud guys and this and whatever, but the profits are going to only shrink, in my opinion, because it's going to be commoditized and the like. But my point is, then all of this has been financialized. Meta doesn't want a $28 billion data center. They don't want that on their balance sheet, right? So they do a deal with a BDC to put, and they raise money from KKR, and they put it in a special purpose vehicle, and then all of that finds its way into ETFs, and it finds its way into your 401k. Okay. And then here's the story that I just really wanted to get to. Deutsche Bank, this is, obviously a German bank that's been funding lots of service providers to the hyperscalers. They're already looking to hedge out their risks. There was an article in the FT. We'll put it in the show notes. And when you just think about that, everyone's learned their lessons. They've learned their lessons they're talking about literally buying credit default swaps or shorting baskets of stocks or using complex derivatives. And if we're already starting to think about that right now, before we've seen really commercial viable sort of products, that's kind of scary. If the banks are telling you we're already getting a little nervous about this.
There was this great, actually, I don't know if you're familiar with Eric Newcomer. He has a very, well-read newsletter in Silicon Valley, and he just did this whole, he dedicated his latest newsletter to neoclouds, right? And
so that'd be CoreWeave and Nebius and a few others there. Lambda?
Yeah.
Yeah, okay.
And how, they're just it's race to basically raise billions and billions of dollars and go public. And it is ripe, right? I mean, Deutsche Bank going for the shorts on these is an interesting opportunity, and we don't know how that...
Well, it won't end well in the near term, I'll tell you that much. That is a matter of fact.
Another hissy fit, right? Is the CEO's upset with short sellers.
Yeah, the thing about CoreWeave, too, is this company loses a lot of money, and they're not expected to make money until 2027. They've taken a shit ton of debt out to fund this expansion. And, my belief about the neoclouds is if there is ever a glut of supply, these guys get screwed first.
Right.
Okay. Oracle has to raise a ton of debt to build out this infrastructure to actually be able to, service AMD. And they're starting with 1 gigawatt. Well, that's a $50 billion commitment. And 4.5 gigawatts, I can do that math. That's $200 and something billion. They don't have the balance sheet to do it. They're trading at 500% of debt to equity, whereas the major hyperscalers are not. And they also have other levers to pull. They have other uses for that cloud, compute, right?
I guess the argument, though, is that if you think that you're always going to need compute power for inference, right, for your kids, your mom, whoever, using ChatGPT all day, every day, I know my mom already does that, then you're going to need that. And that's the gamble, right, that these hyperscalers are making. Yes, there's the training part of it, having the biggest, best models, but then there's also just pure usage. What did Altman say the other day? Need, 1 GPU per person?
Yeah.
On the platform, which is just crazy to think of.
Yeah, I mean but that's years away, and you heard these guys talk about. You hired Johnny Ive for $6 billion to create some multimodal device that you're going to be literally have your own. You're going to have your own whatever you call it. You're going to have one You're going to have one GPU at every person. You're going to have your own ChatGPT sort of thing.
You're going to use it all day, every day.
Yeah, your own AI. I mean, listen, I'm taking the over on everything these people come out with, whether it's Optimus, whether it's flying this, whether it's just take the over. Always take the over.
What about driverless cars?
I mean, those are happening now. No, you and I have been in Waymos together. I mean, it's amazing, but do they scale? You know what I mean? Like the point is, when I'm in California and I'm in a Jaguar SUV with $150,000 of LiDAR equipment and all this stuff on it, does it scale? I mean, so does Robotaxi, is that probably the best bet if they're using AI technology and they're not using all that complicated hardware? And maybe Robotaxi is the one that does it.
Don't count out Google figuring out how to reduce costs and do this for cheaper, as they have done with
I'd much rather trust Google than I'd trust Elon Musk and Tesla.
With you on that one.
So,
but both things can be true. Okay, so we have overshot, right? And there's just so much money in this AI ecosystem. A lot of it propping up each other. As you said, I think a moment ago, AI is going to be is the biggest platform change. But same like the internet, right? There was a bubble. It had to deflate. And then it had to continue on with a little bit more. Yeah,
you're right.
Reasonable.
I mean, we could have a bubble pop. And you could have all the major hyperscalers that have these amazing balance sheets, these monopolies, these managements who have navigated, the list goes on and on. They could be fine, and you'll see a bunch of the neoclouds and some of these other Johnny-come-latelys, get absolutely killed, and they're going to go the way of Pets.com and this and that, whatever. But the one thing that people forget is that when everyone was all hopped up about GPUs being used for crypto mining, when they were all hopped up about the metaverse spend, this goes back to late 2020 into 2021, Meta, Nvidia, Netflix, okay, they all sold off.
Remember FANG?
Yeah. People forget from the 2021 highs that Tesla, Meta, Nvidia, and Netflix, they sold off 70%. They lost 70% of their value. So in April, I just said that Nvidia sold off 43% peak to trough, after the DeepSeek into the April lows. No one thinks that can happen again.
I hear you, but that was a blip too. Isn't it remarkable how quickly we recovered from that?
Man. I mean, but listen, this goes
it's a hard year.
This goes back to I do a show called Fast Money. You do a show called Tech Check.
Yes.
They kind of meet in the middle somewhere. What I know after meeting thousands of retail investors, as long as I've been doing CNBC over the last 16 years, is that when you have these euphoric periods, people get sucked in at the top.
It was painful.
And then they actually add the whole way down. And then they actually puke at the bottom. So what Guy and I try to do here is we try to kind of put a little bit of history into this. We probably put some context into this. We've seen it before.
Yeah.
We saw it in the .com. We have a lot of scar tissue from the financial crisis too. And there's no doubt these things will happen again.
And if you look at the rest of the companies and the rest of the economy, right? That's what makes it scary this time around, is that basically we're relying on a handful of companies right now. And it's tough out there if you're not, in one of these.
It's tough out there.
It is, even if you are, right? We can talk about another time, talk about the labor market and what we're seeing in terms of jobs.
Yeah.
So.
And we're just starting to see, like, a lot of folks were saying, oh, no, AI hasn't really affected jobs. I think, one of the things that I hear again and again, and I know you too, whether it's really small business or big business, when they're losing people, they're not replacing people.
Yeah.
Like, and that's really something I think. So job openings, those are going down. All right, let's hit two really quick things that I think really tie well into this whole conversation. So we just spent, 20 minutes talking about the hundreds of billions of dollars that are being spent in this arms race, and who knows where we end up. So this was Wednesday afternoon. Snap is a name that we do not talk much about. It had an enterprise value, I think, going into its report the other day, of $17 billion. So it's just an afterthought if you think about relative to some of these other, digital platforms that have hundreds of millions of users. Snap was up 20% after their quarter. It's a decent quarter. I mean, no one knows what the hell they do anymore. Like, they monetize maybe through some advertising.
Hey, the kids still use them.
No, I do. But they don't monetize the kids.
Right,
That's been the issue that a lot of us have had. I know you have kids who have Snapchat. My kids literally just still do this.
You kidding me? No, my kids don't even have phones.
Oh, you're not allowed. Yeah. Your kids are young. But my kids are 20 and 22, and they don't use it for anything other than Snap Maps. And and they age out of this stuff. So they're getting $400 million in 2026 from Perplexity in both just in equity. They're getting Perplexity equity. I think that's interesting that Perplexity is using their currency as they've gone. When you and I first met Arvind, I think they were raising at $1 billion valuation, and now maybe at 20 billion, that sort of thing. Yeah. And so I think that's interesting, their ability to kind of use some of their equity, and they're paying Snap combined $400 million in 2026. That's 7% of their existing revenue. I mean, and they have not had to spend on capex. What do you think of a deal like that?
I think that the stock popped 25% after hours trading. So there is still that sort of AI by association works. Who knows if that lasts?
It's given a lot of it back.
Yeah. I'm confused by this deal. It seems like just a way to get equity in Perplexity because Perplexity is a wrapper. Yeah. They don't really have their own models. They're tinkering with that now.
Little models. Sonar, I guess, is right.
Yeah. So it's a weird deal for me because you could really plug anything in. But it feels like a way to maybe partner, because what Perplexity has done really well is have a really great user interface, right? And if this can be fed to a younger generation, as we just talked about, that's using Snap, that could be good for Perplexity and good for Snap.
Yeah, and my quick take, and I know Evan Spiegel, he stayed out of all the fray of all this stuff with the other big tech guys, and you could say, well, they're little tech. They are little tech. He doesn't have the ability to flex with his market cap, and he's not a 10, 50, 200 billionaire like some of these other, folks who are running these big platform companies. And Perplexity is also, the underdog in this space as a tiny little company going up against Google, going up against Meta, and so maybe they see this as a pretty decent alliance and something they can build on. Snap has hundreds of millions of monthly active users, and Perplexity is trying to take a stab at all these other folks. So I like this sort of deal. I don't know what it means for the stock,
Goes back to sort of what I said about OpenAI and ChatGPT, right? It doesn't really matter. Like the model doesn't actually matter to 99% of the people who are going to use it. It's just that interface. So in that sense, it's interesting to see a Snap and a Perplexity, these two very much smaller players, join together and try and take some of that market.
Yeah, by the way, these guys have to come up with things that they can verb, you know what I mean? Like Google or Uber, you know what I mean? Like, no, I'm being serious, none of them, you can't ChatGPT something or Perplexity something or, you know what I mean? Or Claude something.
Everyone still, I feel like ChatGPT has become a verb.
Yeah. I won't.
It's not. I would prefer something else. But
all right. So this was the most interesting thing that I saw on the deal front last week. So Apple nears deal to pay Google $1 billion annually to power their new Siri, which is obviously going to be the backbone of Apple Intelligence. One of the things that I'll just say is that I thought their whiff on Apple Intelligence was a real problem. This goes back a year and a half at WWDC, I think in 2024. And the rollout was a disaster. It was very un-Apple. They did not have the product that they said and marketed and everything like that. But in hindsight now, the stock's back at all-time highs. You say to yourself, okay, well, they haven't spent hundreds of billions of dollars to build a model. Now they're spending $1 billion a year to get Gemini, and Google already pays them $200 billion a year for exclusive search on Safari. Seems like a pretty good deal, D.
So nothing changes. We did this exact story like a year and a half ago. I think we called it, this was another Tech Check take on YouTube. Mm-hmm. Is Apple the dark horse in the AI race because they haven't spent, right? And you can just sort of back end a model, a really great model, whether that be OpenAI's or Google's, into 1 billion plus devices around the world. And it's funny that we're here again. As soon as people start to get skittish around the capex from the other companies, you look at Apple and go, okay, well, they haven't basically spent anything compared to the other mega caps.
Single digits of their revenue are low. That's crazy.
And
those companies are spending 25%.
And it's like, that's why I say I understand Google spending billions and billions of dollars, hundreds of billions of dollars, to develop their models, because they can actually serve it to players like Apple. But I don't know. It would be so fascinating if we look back in a few years and say that Apple actually had it right and they didn't. But that's what we're saying with the Chinese models
by the
too,
way,
right?
I think they do have it right. And we know that Apple in China is going to partner with a Baidu or an Alibaba or something like that for their models and for their cloud, because it's going to have to be there on, in their firewall. The one thing I'll just say, and I think this, just to put a bow on the whole conversation we've had, is the model that Apple is going to be basically licensing is a 1.2 trillion parameter model. This is as good as it gets out there right now. And, this is for context. This is from the Bloomberg article that Apple, they're working on these small models, 150 billion parameters. Now, I can do math, you know what I mean? That's like 10x what they're licensing for $1 billion. So think about the compression that you're already starting to see on pricing for these things. So it's $1 billion in revenue that Google is getting to license this model to the second biggest market cap company in the world.
Isn't it funny how that's changed as well? It used to be Google paying Apple to be the default search, and now it's Apple paying, and
they're probably just kind of crossing it off. They're just, you know what I mean? They're not even like spending $1 billion.
It is funny though, because now we've almost come full circle, and this is what, talking about AI does to you. But if you are going to turn this on and there's 1.2 trillion parameters, you're going to turn that on for, iPhones. Yeah. You are going to need that compute power.
Yeah, no doubt. Okay. Well, listen, Dee, we covered a lot of ground here. I don't know if we said this at the beginning of the conversation, but we're relaunching OK Computer. That was our very fine tech podcast. Guy and I had wrapped it into the Risk Reversal podcast coming into this year. And we thought, you know what? Let's take it back out. We'd love to get more Dee Bosa. We'd love to get more of these folks. We have a lot of great VCs who were contributors to this. We've had a lot of great tech CEOs and operators in both public and private markets over the last year or so. And we're like, you know what? These folks, these conversations deserve their own brand. We're bringing it back.
Love it.
So, Dee, I really appreciate being here in person. I hope we do a lot more of these going into 2026.
I will see you from San Francisco.
All right,
absolutely.
Thanks, Dee. Stick around for Guy and my conversation with Shannon Murphy, head of research at iConnections. Welcome back to the Risk Reversal podcast. We are joined by Shannon Murphy. She is the head of research at iConnections, obviously one of our great partners.
For quite some time.
I think almost 5 years.
You know what's
we're going on
amazing to me?
now.
We were talking to Shannon before this show started.
We were.
I said, how long you been? She said, about a year. I said, come on. She said, yeah. I said, were you at the conference last year? She said, yeah. I said, what?
And what did I say? There's nearly 5,000 people there. So the fact that he's here.
She interviewed Lazary and Eli.
She's big time. Okay.
It's fantastic.
Can we bring her in? She's sitting right here.
She's sitting right there. People see.
So we got a lot to talk about. Shannon, welcome to the podcast.
Great. Thank you for having me.
All right. So a lot of our folks, a lot of our listeners for years, they know of iConnections. A lot of them are customers of iConnections. They go to their events. But the events guy are really eye candy, if you will.
What does that mean?
Well, they get to see Guy Adami up on stage.
Sure
Ron Biscardi.
That's a draw.
Obviously, Shannon. But Shannon's going to tell us, a little bit about her background.
Which we're always interested in.
Which is very interesting. And she's going to tell us a little bit, or remind our listener a little bit about the platform, because there's a lot of very interesting things going on there. Huge investors, huge asset allocators. It's global. And so we're going to hear a little bit about that customer base, but also a lot of the data that you pull off of it, because I think that's a big part of what you do there. All right, let's talk about the background. I know her background a little bit.
You don't. If you know, you sit back and listen. Okay, I don't. And obviously the viewing and listening audience doesn't know. And I've always, when I listen to these podcasts, which I do from time to time.
You do not.
I like to know a little bit about the person. I think people really want to know. So tell us a little bit about yourself, where you worked. I found out this before the show, but where you went to school and what that said major was. So take it away.
Okay, great. I am at iConnections, been there for a year. Obviously, prior to that, I was at Jefferies and Credit Suisse for about 12 years. Really both great platforms. Love my time at each. And before that, I was in academia for about a decade. So I have a background, research and analytics. Schooling questions a little quirky.
Well, let's hear it. This is what makes it so fascinating.
I have a graduate degree in theology.
So I love that. I mean, Rene Descartes, you can go deep in this stuff. I think, therefore, I am Bill Hochman. I mean, this is wonderful stuff.
If Guy wasn't a football player at a Jesuit college,
I took a lot of those classes.
You might have gone into, rather than to Drexel Burnham right out of college, you might have gone into the divinity or something like that. Yeah,
could have been. Okay. Anyway, I think it's fascinating. And it broadens the mind. It allows you to think differently than most of the people in our industry. And it probably, for you, I'm sure it's a huge plus in the way you think and the way you look at things. So speak to that.
Yeah, I think it's one of the ways that really helps you understand what makes people tick. I think it's a great balance. A lot of the other schooling I had was very kind of obviously math heavy, stats heavy, and it's a different kind of logic, right? It might not be intuitive to everybody, but it's intuitive in one way, shape, or another to a lot of folks or to people who are important to them. So it was a really interesting couple of years. I focused on public policy and religion. And this is 20 years ago, so it was a pretty interesting time for that. And I think it's actually kind of coming back to be just a driver of how people act, whether it's in Washington, here, or anywhere.
You know, Danny Moses talks about behavioral finance, and that's something I'm fascinated by. This is that background is probably giving you sort of a different angle as to behavioral finance and why people in our world do the things that they do.
Yeah, I think it helps explain hurting a lot, and you really understand who the different people are who can make a certain group of people act in one way, and it's often not the person you're initially thinking is going to drive that behavior.
So a natural progression from theology degree to Wall Street, just kind of put that one together, because you just mentioned, obviously, as a background guy, agrees with you, pretty interesting stuff, no matter what you went out to do. How did you get from there to here?
So I stuck around. I did research, ran a research program at Harvard for a couple of years, and then went to business school. So that was really the hinge that bridged those two worlds. And from there, went to Credit Suisse.
The iConnections, sort of the leap to iConnections, seemingly logical, but what has it allowed you to do? And let's talk about your role there.
It is a fantastic platform to build something. Like these guys, Ron and Caitlin, are builders, and it's really exciting to be part of a platform that's at the beginning of its growth life cycle. And the events are well established. You know, you guys mentioned 5,000 people meet us in Miami every year, and we're known for that. We've put an enormous amount of resources in our platform. So we have 3 main flagship events throughout the year: Miami, New York, Asia. And then we're really building a platform to help capital move the other, 48, 49 weeks a year. That's really falling into a couple of different verticals, if you will. A lot of it is the very basic, let's connect allocators and folks who are looking for capital for whatever reason. It could be a co-investment, it could be a fund, it could be their 4th fund. So it's a very expansive platform. There's a lot of depth and different kind of niche strategies, but it's also really bringing some of the innovation that we've seen in Silicon Valley, whether it's an AI overlay to facilitate search, really different kinds of creating meetup opportunities, messaging opportunities, so that we can help people connect year-round, 365.
All right, so let's talk about the size and scope of what you have, what you're privy to, and the amount of information there that you get and basically are discerning and using. So it's a staggering number. You talked about it before.
Yeah, we have thousands of GPs, and we have basically 3x that on the LP allocator side, which is great. Like a 3-to-1 ratio is kind of a sweet spot for people. There aren't too many relationships to swipe around on, but there aren't too few that you're coming across the same funds or allocators you've met 50 times. LPs have about 50 trillion in AUM.
50 trillion. I mean, that's a staggering number. Yeah.
And we think that that's really a nice captive number.
Yeah.
Because in any given quarter, a lot of it has to get put to work. And frankly, a lot of it's planning for its next 3, 7, 9 quarters ahead.
Just speak to that. You talk about these allocators, they're global, right? And we know a lot of LPs, these are funds here in the US. To your point, they kind of know all the faces here, or they know a lot of them, right? And so now just a big part of this entire community is looking away from the US. Now, it used to be Europe. Now, obviously, Asia was next, and now it's the Middle East. So talk to us a little bit about how the platform facilitates that, because it used to be a very fragmented relationship sort of business. Now, as you just kind of mentioned, I mean, you're leaning into technology and you're providing this platform for, both sides of this trade, if you will, that obviously would have a hard time replicating this sort of, platform to kind of facilitate their own capital allocation and raising.
Absolutely. And you become kind of a trusted advisor when you have that many people meeting in person under your umbrella. So in the expansion to Asia and the Middle East, one of the things we've seen in the last 2 to 3 years is the true maturation of the Asia market. I think a lot of us have been waiting for that for maybe 15 years, 12 years for sure. But we're really starting to see that in terms of interest, flow numbers, a lot of the strategies that had been kind of lagging in Asia, so let's say private credit, for example, we've seen the exact same amount of demand from Asian LPs as from European LPs. Like they're almost at parity. And a couple of folks have started talking about is Singapore, the new Zurich. I don't know, I think it's still a little early, but the growth of the family office space there is absolutely kind of indicative that it's a place to watch.
So sitting at the perch you sit at, it's a much different seat than at Credit Suisse or at Jefferies. And again, you have access to so much data. What has surprised you in the year that you've been here in terms of just seeing flows, seeing interest, seeing these different meetings with allocators and those types of things?
I've been surprised at how many, to your point about behavioral finance, how much behavior and psychology that we just think about in our regular personal lives shows up in our professional lives. When an LP tells us they think they want XYZ strategy and they meet with 3 strategies that have nothing to do with their list, that's interesting. And then they allocate to 2 of those strategies that didn't even pop up on their first list. It's really the ability to see how people behave that's interesting to me, because we can all say, oh, I think I want X, Y, and Z in an apartment or a partner, but what you end up with is often not kind of what you had in your mind.
So next level, do you point that out to those individuals, or do you sort of let them do their thing? Is there the next iteration where you say, you told us you were looking for this, however, you wound up being in 3 different areas that really don't line up? Is that something that's talked about?
Especially on the manager side, because I think folks are really focused on, oh, I need to get in front of the guy who says they want private credit. But what we've seen, and we can talk about this in a little bit because we just did our first allocation studies, we know where money's going, is for folks who might not have even indicated interest, if they're taking a meeting, they're obviously more interested. They're giving you their time, and they're more frequently writing the checks. On the investor side, it's more about casting a wider net and saying, kind of the Netflix model, if you like this, you might like that.
Why do you think that is? Why? Because it's fascinating, because you basically create the framework to people to find what theoretically they're looking for, yet somehow some people don't do it. Why? Again, it's behavioral finance, but it's not necessarily that they're being dishonest in their answering the questions. It's just they're being led to a place they might not have thought of.
Yeah, and the world changes, right?
The world changes.
Think how fast the world and the markets have changed just this year. So maybe what you thought you needed 2 quarters ago, you've undergone a complete portfolio construction asset reallocation study, and you're changing faster than you can tell us what you want. So we really lean into that behavior to understand how can we be more helpful to both groups and make their time and the time they spend with us on the platform as effective as possible.
Yeah, let's talk about going back to late January. Global Alts was going down in Miami, and Fast Money. We were down there for 2 nights. I think it was the Tuesday and Wednesday, and actually it was the Monday and the Tuesday. And we're sitting there in the morning, getting ready to kind of do all the stuff that we do. We're going to podcast down there. We're going to do the television show. We're getting ready for a full day of content that was, moderating panels and the like. And there was a piece of news that dropped that Sunday night, and it was about a Chinese model that was going to compete with ChatGPT and everything else that was built over here. The markets went haywire. Do you remember this? I mean, it was not something, this was not a great place to be away from the office if you were like a multi-strat, fund manager and the like, because it wasn't just, tech stocks, it was everything. It felt like every asset class moved. Now, that was one day, things kind of cooled out a little bit, but to your point before, then we had all of this volatility again in almost every major risk asset leading up to the tariffs and then after. How quickly do you see just kind of the interest of allocators move around? And why are we speaking about allocators? Because they're the ones putting the money in the fund's hands that are going to put the money to work in the markets. Just give us a sense for that, because we have had a bit of volatility based on some big macro issues, things that for the most part people don't see coming, right? And then even the stuff that are advertised, like the tariffs, they went a different way than a lot of people expected. So how quickly do you see appetites change in among your customer base?
For certain verticals, like family offices or groups that can move faster, we'll see it faster. It'll show up and they tell us, not necessarily who precisely they allocated to, but they're looking for the next great co-investment manager. Who have they not seen? So we are within at least, let's say, the quarter, able to kind of directionally understand where the faster money is moving. Bigger tickets obviously take longer to write, but we can get a sense of tariffs happen, second model of Chinese ChatGPT rolls out. How are people reacting in the short term, and how are they thinking about repositioning in the medium?
Yeah. And, some of those funds that you talk about have the ability to kind of act on that information, these massive multi-strats. We all know the names. They're big names, that sort of thing. It was interesting to us going back, let's say 10 or 20 years. And, it used to be some of these funds you could not get capacity in, right? They were the hottest funds. They were outperforming the markets dramatically. And now, without naming any names, you see they have built out huge infrastructure to raise capital. These are also the ones that are on the road. They're at Singapore. They're in Hong Kong. They're in the Middle East, that sort of thing, which is a huge sea change, I think. And some of their big principles, they're, we know the names, right? They're out there humping it too a little bit. Talk to us a little bit about that dynamic, because to me, that's a very, very different sort of setup than it was 10 or 20 years ago.
I think it's one of the most interesting shifts in the last 10 or 15 years, right? You have the old adage of hard closed is soft closed, soft closed is open. And I think what people really understand is capital formation is not a single part of your strategy. It's the first part of your strategy. And you need to be pivoting to not only retention, but product and pipeline management all at the same time, which is why you're seeing these founders, these household names out there in a way on the circuit that maybe 10 or 15 years ago would have been like, I'll see you when we're open. So I do think it's better for the industry to have this much kind of quiet capacity open and thinking about, one of the largest multi-strats rolling out a new credit product, which might have surprised some folks. I think that's interesting.
You mentioned you're coming off basically a big survey that you did. So the data you collected must just be extraordinary. What stands out to you? What are you seeing? Any themes?
Yeah, it was amazing to me that we got, first of all, this much money. The other probably shift in the last 15 years is how cagey folks are about where they're putting their money, right? We asked both allocators and managers so we could kind of check their math, and you wouldn't have funds saying, oh no, I'm super deep in diligence, or, I have a date with that person, and the allocator's like, me?
Yeah.
$600 million has already changed hands in the 7 months since Miami. That's a lot pretty fast. It's a great year for capital flows in general. We haven't seen numbers like this since 2007. But the magnitude of that already is really much larger than I expected, because people were tagging ticket numbers to us and saying, we wrote a $5 million check. We wrote a $10 million check. And then they would tell us, have you moved into diligence? Which you usually don't put a guy on an island when you're kind of diligencing them. You're trying to move it forward. So at least a third, maybe 40% of the GPs who we saw in January have either received a ticket or are in diligence, and some GPs have gotten 2 tickets. And again, this is not them telling us. We've checked the math with the LPs.
And the math checks out. So, you're surprised by that number, $600 million, and we're in November of the year. So 8 or 9, let's call it 9 months or so in. Let me ask you this. What does that suggest to you, that people are seeing something out there in the world, something's changing? Or is this sort of, I don't think there's anything normal. You just said the number was large. What does it suggest, though, in terms of your behavioral finance background and your history in the business?
I think we have entered into a bit of a tailwind period after a couple of years of headwinds, right? Like we had 8 or 9 straight quarters of outflows in 18, 19, and early 20. And there are a lot of things, whether it's kind of the dislocation of central bank movements across the globe, all of a sudden people want macro strategies again. Private credit has done well. There may or may not be cracks right now that they're thinking about. I think people are being pretty tactical with their capital because they can't either be fully invested or in cash.
Right.
They want to put money to work.
Let me ask you, on the macro side, has gold found its way into sort of the data that you're getting? Are you seeing it more than history suggests in terms of your work?
Yeah, it's pretty early on the commodity side. Like we're starting to build out that sleeve, but I would say macro in general has seen a pretty extensive ramp up in the last 2 years. We have data going back to 2021. It's really robust from 22 forward.
Right.
And macro's just kind of gone parabolic.
All right. What about VC? I mean, this is something that, Guy and I now, I think it's our 4th year that we've been at Global Alts, and we see that as a building sort of vertical. And I have a lot of friends who actually, I think they listen to the podcast, they hear Eye Connections. These are folks out on the West Coast for the most part, and they're asking me 2 years ago, hey, what goes on there? All it takes is a few friends of yours who were there and say, that was really value added. I got a lot of great meetings. I would have had to travel all over the world possibly to do those meetings, but I've already now heard from, let's say, another dozen friends. This is probably across the U.S. who are going to be there in February when you have your next one.
Yeah, I mean, I've heard it described as like the world in a week, and it's great that it's the first quarter. For VC specifically, what I see is like smart money is still really going into VC, and it's the kind of partners that the VC funds want. They're not going to get impatient. They understand that the best last cycle for VC investing was after the dot-com burst, right? Like very happy or not happy, but understand that there might be challenges in that sector in the next couple of years and are still very much excited for that play 7 to 10 years down the line and want to meet the best VC managers in the world to find those partnerships.
Yeah, and it's not too different, let's say, the multi-strat world. They got so big, right?
Yes.
And so as you see, folks leave some of these big last generation, let's call it VCs, they get really big allocation or, from a capital standpoint, but also from a personnel standpoint. And then you also see really successful companies, and you see folks leave those tech companies and then they start investing. And so I'm just curious, like when you think about just the way you described it, I mean, that's kind of long duration assets. I mean, that's like a really good time. Like you just said, at the dot-com or after the financial crisis, these were great times to be deploying private money in tech. So do you expect that to continue to grow no matter what happens, let's say, with this AI, public markets, and then what's going on in and around OpenAI and the kind of, AI build out as far as, let's just say, all these unicorns? I mean, we've never seen so many of that sort of thing. So this is probably presenting a really good opportunity for you guys to lean into this vertical.
Yeah, it's done 2 things, right? I think it is, just to go back to, a good partner versus a skittish partner, right? Nobody wants a skittish partner. If you're already having headwinds in your portfolio, you don't want to get on the phone and explain 12 times why it's going to be okay. I think the other thing that's created almost this kind of ecosystem or penumbra with the AI enthusiasm is people are excited about startups again. Most people are very excited about AI. There may be some naysayers, but I think in general, the idea of building American companies is very exciting for a lot of folks, and people want to be involved in that over the long term.
From your vantage point, you're still focusing, you're not focusing on, but you still watch what's going on in the markets. As we're sitting here again, early November, what have you sort of gleaned? What surprises you? What do you think's going on out there? I'm curious.
I wonder where we are balancing this kind of Teflon market we've had for the year, and I would include kind of Liberation Day post that. But I do see some allocators, LPs, and even managers, investors who have been doing this through multiple cycles and might have the muscle memory from '08. We have an AI search feature in our platform so we can understand what's important to people. And I'm starting to see more defensive terms. So things like drawdown, which obviously means how down has a fund ever gone. Understanding, okay, in 08, the market was down 38%. I was only down 8%. My drawdown was much better. I'm starting to see searches wondering about market neutral strategies where you're not taking directional bets. How big are certain, obviously more liquid funds drawdowns?
Let me ask you this. Do you think that is, I think I know what the answer is. I'm curious, your leading indicator or lagging indicator in terms of, what the market is setting up for?
Leading. It's kind of everyone's incognito browser.
Right.
Right.
That's why I'm asking. That's what I think as well. So,
what's in your incognito browser?
I can't say.
Okay.
Incognito.
Do you even know what that is?
I know what the word incognito
No, but
means.
do you even know that there's a tab on your browser that you can actually go in on?
Brian Kelly once told me there's something called VPN, and I guess
Virtual Private Network.
That's what it means.
That's how the Chinese access
I'm
the
not
internet
Chinese though.
In China.
So
That's
why would
how they
I need
access. Or if you were you wanted to access a Binance account outside the U.S. And you
there was a
could
guy
use
that played
VPN to do
in
that.
the NFL. His name was Richie Incognito.
Yeah.
Remember that?
I don't know if it's spelled the same way. Was there an A at the end of it or something like
sure.
that? Okay, going back to the incognito mode, this AI tool, it is fascinating that all of a sudden you can take all of this data that you can have it structured, but then you can get all of these unique insights, right? And so when I think about just some of these searches, I'm just curious, are you seeing things like interest rate environment, or are you seeing what does a high tariff environment mean for this, that, or the other? And does that give some sense about geographic interest also?
Yeah, I think everybody's trying to shine up their tariff crystal ball, and it doesn't seem to be working for anyone yet. If we all knew what was going to happen, there wouldn't be as many conversations, headlines, and searches about it. I actually don't see a huge regional slant. I see a lot of cross-regional interest. I see a lot of Asian investors very interested in U.S. or Canadian opportunities, particularly around infrastructure or digital infrastructure. I see a lot of European investors who are interested. You mentioned it, the Middle East, Asia. Interest rates are always kind of in vogue. I don't think that people really know how to play that, especially after the last meeting.
More back burner stuff.
Back burner.
So as you're growing into this role, you're about to be on year 2. You have a year under your belt, so you understand the inner workings. How do you want to sort of put your stamp on iConnections? What are you looking to do going forward from here?
I would love it, and I think this is true of the entire platform, which is frankly why I'm there. It's fun to be a part of building something that you think is useful. I want it to be useful for people who are moving trillions of dollars in the world. I think that this industry has relied on relationships for so long, and it is critical for gut checking references, et cetera. But in terms of surfacing, discovering new ideas, you never know where the best next idea is going to come from. And I'm really excited to help build out that kind of behavioral intelligence that might help investors do that.
Is there an institution out there that would potentially be the final piece to the puzzle that is not currently on the platform, sort of like the Moby Dick, you're Ahab and, the Moby Dick out there?
I'd have to think about that. That's a kind of world is your oyster, bottomless pocketbook question. I have not thought about that.
Well, that means she's got to come back to it.
Well, she can come back anytime she wants.
Obviously, but
you can come back with. That, by the way, I read the book. It's 600 pages. Read it in high school.
So it's interesting. So
I am. Remember how it starts?
Yeah.
I am Ishmael.
Ishmael. Yeah.
The name of the boat was the Pequod. You remember this?
Pequod.
Pequod.
Not with a T at the
No.
end?
You're thinking of Pequod.
Capital.
The fund. It was Pequod. OUD was the boat.
I've been to, and I was actually visiting the aforementioned.
Call me Ishmael.
The aforementioned BK. I've been to Nantucket, and they actually have a museum there. I think the boat left from Nantucket. All right, whatever. Here's the deal. We've known Ron now and Caitlin for many years. We've seen how the company has evolved, and it's really interesting, the in-person stuff, the tech platform that you built, embracing AI, but now Shannon Murphy. and the theologist who's coming here, dropping her insights onto this whole. She's imprinting herself, guy.
She thinks, therefore
platform.
she is.
There
she is the Rene Descartes of eye connections.
All right. Well,
she is not the John Paul Sartre of eye connections.
No.
Who wrote Nausea. I read that as well. Deep stuff.
He's a reader.
I also read, if you really want to get into the weeds, The Metamorphosis by Franz Kafka.
Did you hit that
dark
one?
stuff.
No,
I did not. I missed that guy.
Gregor Samsa. If you treat the gist of it is, if you treat somebody like a bug, or if you treat somebody like shit, they will turn into said bug.
Really? So it's up to you that they.
Well,
that
I mean,
happens?
it's just
I'm
it's
not
a very.
sure
I'm
about
telling
that.
you, you might want to read it.
Yeah.
Do yourself a favor.
I won't. Shannon Murphy, thank you for being here.
Thank you so
We'll
much
hope
for
you do it
having
again
me.
really soon.
Great. Thank you.
Thank you.